Good morning, I'm Chris Beach, and welcome to Charting the Markets on IG Live. And markets continue to tread water, more or less, as they digest, particularly in equity markets, digest the gains of the last 6 weeks or so. We have seen some weakness creeping, most notably in Chinese markets, really, which have been declining all year and indeed have hit new lows for the year, 13-month lows now for the Hang Seng in particular, which we'll look at in a minute, really, as disappointment continues regarding the performance of the Chinese economy and outflows continue to hit equity markets there. And that's really where the divergence is at the moment in global financial markets. Otherwise, not too much of a busy morning, really. You can almost feel it's December. Not much in the way of data, but you did have the Australian Central Bank, the RBA, leaving rates unchanged at their latest decision. And given they don't meet again until the 6th of February, it was interpreted as something of a dovish move, really, that the central bank didn't see the need to do anything proactive in fighting inflation for the time being. And so markets, again, have taken that as a sign that, of course, inflation is still moving in the right direction for central banks, although very much a known, if you like, so hasn't been really able to drive too much of an upsurge in stock markets. The Dow finished down yesterday, and we're expecting a weaker open for US markets, which follows on from a very mixed open for the European markets this morning as well. But let's start with the indices and with the Dow. So it's currently trading in futures at 36,148, and that's very much around where it was on Friday, really. We climbed, as you can see, on Friday, 2 strong days to end last week for the Dow. It's near vertical move now, taking us to the highest level for this index since January of 2022. No sign of it slowing down either, really. At least pausing is the only thing we've got so far, maybe a couple of 100 points off the high of last week, but that came off the back of Jerome Powell. Now, of course, he didn't say anything particular about rate cuts. He really suggested that there were no thoughts of rate cuts at all, but because he didn't say it in any stronger language, the market took it as an excuse, particularly in US stocks and things like the Dow, to rally. And that's the interesting thing at the moment, as we'll come to the Nasdaq in a second. You're seeing the Dow, and yes, they small caps as well, really taking the lead while the Nasdaq dropped to a 3-week low. If we do see maybe a kind of short-term pullback, then the natural destination might be these highs from late July, early August, around 35,600. And that would wipe about 500 or 600 points off the index and just lead us maybe set up a short-term pullback and then see whether buyers can muster a defense from there. If it starts to go below 35,500, maybe you've got the makings of a more substantial pullback. Now, of course, given the fact the index has moved trough to peak a whopping 12% in the space of about 6 weeks, 3,944 points, you wouldn't maybe be too surprised, or I think you shouldn't be too surprised to see maybe 700 or 800 points knocked off the index from its current levels, but maybe before it starts to move higher again. I think we should anticipate that. Obviously, we don't know when, but it would not be unsurprising, I think, if you did have that just shaved off some of these huge gains in the space of just 6 weeks. It's a whole year's worth of gains, really, in the space of 6 weeks, but leaving the overall trend intact. And you can see, just looking at the chart, how overstretched the price is from 100-day moving average, and indeed the 50-day, which is now scrambling to catch up. So usually you see that gap closed. Either the moving averages catch up to price or the price drops backwards. Usually it's a combination of two, to be honest. But in a similar vein, I suppose, to what we had in July, it's not as overextended as it is now, but back then you could see this yawning gap was eventually closed. And then we saw a bigger pullback. But that's the kind of thing you'd expect to see, that market reverts to the mean to an extent. And that's what we might expect for the Dow. And it's certainly, if you're hoping or worrying about a Santa rally for the end of the year, it is slightly hard to envisage one happening given the huge size of the move we've had. Usually for US indices particularly, the first half of December is flat and the second half is where the rally starts. Given the Dow up so much since the end of October, it's kind of hard to envisage. I'm not saying it can't happen, but maybe it is a bit harder for that to develop this year in the short term. Looking over to the DAX, tech stocks really have taken a bit of a knock the last few days. There's no particular reason. Spotify announcing job cuts yesterday, cutting around 10% of its global workforce, which builds on existing job cuts, did put a bit of a chill through the sector, really. But again, we are about 250 points, maybe 300 off last week's highs. And we gained some 1,700 points from the lows at the end of October. So again, it's the kind of pullback that should be the normal thing to anticipate, really. It's just a question of how far it goes. If it closes back below 15,300, maybe we might start to worry a bit more that we've dropped back below these previous highs, and the buyers still haven't been able to muster up a defense. But if it can hold above that, or if it holds above those September highs, then that would be probably a sign that a higher low is being established, and you might get a move back towards 16,000 and higher for the Nasdaq. And of course, back above 16,000, go all the way back in time to the end of 2021, and then it's 16,630 is the record, around the record high. The actual record high, I think, is 16,769 from December, end of November 2021. But overall, consolidation more than anything else is the name of the game for US markets, particularly. Where we are seeing weakness in stock markets is in the Hang Seng. And it's remarkable that in the space of just over a week, really, we've seen the index shed about 6 or 7%. Now, Chinese markets tend to be more volatile on the up and on the way down as well. But we are now at our lowest level, fresh 1 year plus lows. It's the lowest since about the 10th of November, so 13-month lows, really. And this continues this downtrend that's been in place since January, when the index peaked at just below 23,000. It's had rallies along the way. The latest one, it rallied along with other global markets in October, at the end of October, but then it's given up the ghost. And you can see the reversal back below the 100-day, the failure to hold above it, and then the reversal below the 50-day, and then the break of trend line support, all the classic things you'd expect to see after a lower high. So the sellers firmly in charge here, and we're now really eating into the gains that we saw made from the October 2022 low. We might not get back there as quickly as we rallied off it, but certainly at the moment it is, in the short term, perhaps looking over stretch the downside, but it's definitely the one to keep on. People can watch this for a downtrend, because that, by any definition, is certainly a downtrend. You've seen lower highs, lower lows. It's below major moving averages, and so that looks like people continue to sell into strength for the Hang Seng. So while there's all the focus on US markets and how well they've done and how European markets have picked up a bit since their October lows, here is where the action to the downside is really concentrated. Looking at FX markets, with central bankers really at the moment just in a wait and see pattern, saying, well, we don't want to cut rates too soon, but we know inflation has begun to come down. You had another ECB board member over the past 24 hours saying, actually, inflation is moving in the right direction. We're not keen to cut, but certainly the pressure to hike again has disappeared for the time being. So that has knocked some of the strength out of euro dollar, which was previously benefiting from the more cautious turn in the Fed that the ECB hadn't demonstrated. But nonetheless, very, very strong rally in October and November. It unsurprisingly has taken a bit of a knock after breaking above the 200-day moving average. But if you're expecting this to continue to gain, I think you're beginning to see the kind of price action that might support a low around the 200-day moving average and might allow it to then push on towards 110 and back on from there. Might see it gain over the course of time back towards the July highs. That could take quite some time, though. But certainly a defense of the 200-day moving average is just what the buyers really want to see after the pullback. Short pullback, nothing too excessive. If it were to go back below 107, then that might start to get people a bit more jittery about the extent of it. But certainly at the moment, definitely the uptrend firmly in place. You could argue that if you drew a trend line here, it could go all the way back towards 107 and then bounce. That would certainly be entirely consistent with what markets like to do. But that would be quite a pullback, put it back below the 200-day moving average and muddy the waters quite a bit, really. Euro sterling's taken an absolute whacking over the past 3 weeks, really, since that November peak at 87.60, switching dramatically from the euro to the pound by the looks of it, and firmly breaking the uptrend here. It's broken through these higher lows that we saw in November and early October. So really the pressure's on the sellers at this point, the buyers to do something. And even then, if you might see a short-term rally, because it's very much been a straight line move since 20th of November, if it's a short-term rally towards 86.20 and then fails, that obviously then falls into a lower higher category and begins to change the outlook quite significantly, I think, and then puts the lows of July and August into view once again at 85.13. So If you're just looking at it now, certainly it has been a very big move so far, and you might argue you might be slightly late to the party, but definitely one to perhaps to keep on your watch list, as now it begins to change from uptrend from the August lows firmly back into downtrend territory. And then the Aussie dollar, unsurprisingly, the fact the RBA kept rates unchanged didn't do much for the Australian currency. And we're now back at the 200-day moving average. Could be an interesting one to watch, because last week it bounced off the 200-day. So if it manages to do that again, that's a more positive sign. A reversal back above 66.20 might be the kind of thing people are looking for. It's not surprising to see this, you call it profit taking, you call it pullback on the news, really. But overall, it still leaves this move higher from the end of October intact, just as it does for indices as well. So it's not, we're not sounding the death knell on this one just yet. Remember, we had quite a bit of a drop into the beginning of November. We went from 6,500 to 6,350, and then it rallied. So we'll see whether a similar development comes through again. And a close back above 66.80 clearly puts the advantage with the buyers once more. Finally, turning to commodity markets, after rallying, surging, racing to this record high at 21.20 last week and into Monday, of course, you had a big reversal there. It's not really surprising, I think, after such a huge move higher for gold, not just from the middle of November, but of course the beginning of October. You would be bound to see some profit taking come in at the moment. And it's not really a huge turnaround in the trend. It's not a sudden re-strengthening US dollar that could see gold give back all its gains. But unsurprisingly, people did take the opportunity to hit this one hard and push gold back below 2020. So do watch out for that. At the moment, we're still just about holding on to some form of uptrend support from that November low, but it's quite steep. A close back below, say, 2,000 might start to worry people just a touch more. But the fact it's above the 200-day and the 50 days crossed above the 200-day is enough to put gold more in the uptrend category, looking to buy the dips rather than sell the rallies. That would have to go back below 1940 to really start to change that view. And then from something which has kept going up to something which has been mostly going down over the past few weeks, that is oil, but mounting a defense of $78 a barrel for Brent this morning in early trading after 3 big down days for the commodity. The key thing here is that over the past month, it's repeatedly attempted to move above the 200-day moving average and failed. Now the question is, have the sellers finally got the strength to push this one back below the mid-November lows and open the way to these big area of support, huge area of support, really, around the $72 a barrel mark. It's been consolidating essentially during the course of the second half of November after its pullback in the second half of October. At the moment, it looks like the sellers still have the upper hand, and certainly they have defeated the attempt to break higher and really get the price back above the 200-day. So that's a notable success for the sellers. It's now up to them to see if they can drive it back below 77.50, 77.60, and then really put the price on a firm trajectory to the downside. If this still holds as support for the time being, then we're essentially stuck in this range of the past month. So potentially interesting but volatile times for the oil price. The key thing has been, I think, that OPEC decision last week, which, though they went for cuts, they were voluntary cuts, and the market was clearly unimpressed with that decision. And they tried to walk it back over the last few days and said, well, we might do more next year. At the moment, the market is in no mood to believe OPEC, which has put quite a lot of pressure on the oil price. So the rest of the day, US ISM services PMI this afternoon is the main event of the day. We do get job openings for the US economy, so kind of a warm up to this week's job data and for the ADP and NFP reports on Wednesday and Friday, respectively. But the ISM PMI, the main event of an otherwise quiet day, really, for US markets. And after the weaker finish yesterday, we were expecting a bit more of a loss on the Dow and the Open, around about 60 points lower from yesterday's close. But that's it for me. Thank you for joining us, and we will see you again tomorrow at 10:30.